Yes, Swati, if you're in the audience, do you mind making your way up? Thanks. Hi, everybody. I realize this is a difficult job, given that we're, the last panel before the awards and the drinks and all of that, so we'll try and keep it as exciting as we can. In context and based on some of the research that I did, private equity, including venture capital, realized about $17.62 billion worth of exits during 2022. So that number is apparently down 52% in value terms compared to 2021. So the other data points that I have is that IT and ITES companies stopped the exit value chart, and exits via public market sales account for about 46% of the exit value. So we have a fantastic panel here, and the way that we decided to do this is sort of tee off with a couple of questions about exits and have the panelists sort of chime in with their thoughts on this. So with that in mind, maybe get to the first question. And this one is for Gaurav. So, what is the macro environment generally that you believe is affecting exit valuations?
Thanks, Karthik. So, in general, I'd say that there will be volatility on an annual basis, right? And you may have a year where you have a few bumper exits that push up the exit number dramatically. And then, you may not have similar sized exits in subsequent years. So there will be volatility. I think what's more important to see is just the trend. And I think if you compare private equity exits from 10 years ago, from 5 years ago to up to now, you'll see that there is an increasing trend. 10 years ago, 15 years ago, there would be concern around money going into India but not making its way out. DPI was low. I think some of that is behind us now. So the industry is chugging along nicely. You are seeing good exits. Now that being said, in an environment where interest rates are rising, you will see pressure on valuations, right? Valuations are inversely correlated to interest rates. And globally, we've seen governments pushing interest rates upwards to tame the inflationary environments in their particular countries. So that is going to put pressure on exit valuations. And to add to that, you have all this geopolitical uncertainty. Of course, Russia, Ukraine is creating some challenges, but also the tensions between the US and China, that's also creating some issues. So some of those things will make investors risk off, and so you will see some cool off happening on the exit environment. Another way to think about it is that, look, in a good environment, all companies will get sold. The better ones will get a superior premium. The good ones will get some premium. And even the weak ones will get exited. There will be a buyer for them. In a weaker exit environment, you'll see the premium narrow. The good companies will probably get traded at fair market value. But where you'll see the biggest issue is going to be on the weaker companies, because there will be no buyers for those weaker companies. So I think that also happens, between a good exit environment and a weaker exit environment. And then I think, look, it's very, very specific to the company, the sector, what are the growth prospects of that particular company. Some of those things will also play a role. So it's hard to sort of generalize and say it's a weak exit environment. So I'll just leave it there.
Anyone else would like to add to that?
So, Gaurav mentioned the sectoral distribution of this, and I think what we are beginning to see now is that, in the growth capital stage, at least in which we operate, certainly an elongation of timelines, but nevertheless the need for very substantial sort of value addition from ourselves into these companies. So that's kind of peaked a lot if we want to kind of lower the risk and still maintain some timelines for exits to happen.
Fair enough. Okay, so the next one, and this is to Ranjit. So has deal making changed in any way in terms of sort of how you look at exits, reliance representations, warranties, et cetera, et cetera?
Sure. So Karthik, you mentioned some statistics, so let me just elaborate on that. So overall, private equity exits from CY 21 to CY 22 fell by 52%, roughly 38 billion to some 17 billion. And if you go into those statistics, IPOs reduced, well, let's start with strategic sales. They fell by about 74%. Secondaries fell by about 53%. IPOs fell by 34%, and buybacks fell by about 22%. So you had, firstly, this trend across the board. It wasn't selective. It wasn't a beta with, say, public markets. Now, in terms of deal making, what we've noticed is essentially three criteria right now, at least in the market. One is that deal times, of course, are taking longer. The second is that there is a very strong premium for profitable growth. And the third is that we are seeing more and more structured transactions happening. So people are saying, okay, we believe you, but let's agree that if that happens, we'll pay you the price. So those are the three things that happen. But coming to the last part of your question, which is to some extent, how do we deal with that? So there are, I would say, some sort of strategic ways to deal with it, and there are some current ways to deal with it. And in our case, the strategic ways to deal with increasing exitability per se is we basically invest in first generation entrepreneurs, for example. So we don't invest in industrial groups or large business houses. We think that the percentage of exitability is higher there. And the second DNA element in our case is, which I alluded to earlier, is to reduce risk by operating guardrails and very substantial operating involvement. Then there are current things that are happening in the market that we notice. That the timelines that we put into agreements have shortened. The waterfalls for exitability have sort of got tightened. The reps and warranties that we expect, and also at exit, how promoters should behave, have become more specific. So all that is kind of the engineering that we're doing in the short term to ensure that the risk of exits is substantially reduced.
And do you find sort of the companies that you work with willing to sort of walk that path with you to setting up those guardrails and actually complying, or do you see that waffling a little bit?
It's kind of demand and supply, right? In this environment, many more will agree to that. When money was easy, fewer would agree to that.
Fair enough. Okay, so Raj, the next one's for you. What are some of the regulatory hurdles related to exit that you face, and how have you dealt with them? And would you like the mic?
Yeah, fine. It's fine. Thank you. I'll pick each one separately. I'll talk about the regulatory hurdles first. I think if your exit requires the regulator's approval, then I think it's generally okay to say it's a challenging task. For the following reasons, if I were to summarize, typically I would say there is an intent of the regulator versus what is written in the law. And sometimes if the language is ambivalent, then the regulator typically tends to take a conservative position. The second is the whole process of regulatory approval. There is a lack of sufficient visibility on the process. What goes on behind? What are the challenges or concerns that we could address upfront? There is that lack of visibility. And thirdly, sometimes it happens there are multiplicity of regulatory agencies that need to approve and provide an approval. It could be one or the combination of the three, but irrespective, the outcome is always that there is uncertainty over the timeline that it takes as to how long is the regulatory approval going to take. And that could lead to the transaction uncertainty. And this we have seen in a couple of our recent exits where the regulator approval came through, but it came through nearly 9 to 10 months post our approval. Now, if there are such delays, then typically the world has passed on, moved on, and the whole valuation game might have changed. And then how do you deal with it? So to the next question, how do you deal with this? We do try and build in some valuation adjustment mechanisms into the deal making itself to provide for such delays. which is not a welcome thing, but we sort of try and do that. And that way we try and at least protect the valuation to some extent that's possible. In other cases, we also where for instance the asset is, let's say it's a fairly hot property, then we build in timelines beyond which if there were a delay from the regulator's side, we reserve for ourselves the right to walk away, right? So we also have learned and evolved, and we're also doing things that protect our exit value. But these continue to be real issues from a regulatory perspective. On the tax, I would say it is more around classically the intent versus practice. When I say practice, I mean department practice. There are issues that should have been resolved in multiple forums, should never crop up in a conversation, in an exit conversation, but typically a lot of time is spent in negotiations, beating the same issue time and again, simply because the practice is not settled. Just two classic cases where, again, the intent of the government when it announced, for instance, the reduction in tax assessment or reassessment timelines to 4 years with a caveat, and that caveat becomes the conversational point, and it never goes away. And I think it's just a waste of time for everybody trying to sort of interpret what that could mean. A settled issue like beneficial ownership in a treaty gets opened again and again and again and never gets finally settled. So these are issues that I feel have, for our economy like ours, which has now progressed so much, the ease of doing deals, the intent is there, but in practice, it never plays out. I think these are some of the, I would say, challenges that typically we see.
So would you think it's more complex to sort of do an exit where it's not just an India exit, but the Indian asset also has, sort of foreign subsidiaries, all of that, and sort of dealing with the regulatory hurdles, as it were, of different countries actually makes it harder?
Oh yeah, I mean, we typically deal with Indian companies and Indian exits, but the moment it becomes a cross-border issue, then the complexity simply go up tremendously. And then you're dependent on multiple regulatory approvals. Again, one of the issues that we are currently handling cross-border is multiple antitrust approvals, regulatory approvals required, which can simply create so much of deal uncertainty. And if it's going to take a year or a year and a half, like I said, the world has changed by then.
Which sort of speaks back to Gaurav's point, right? I mean, one of the macroeconomic issues here is really the fact that, if you have a country that's sanctioned another, and you haven't sanctioned it yet, that could complicate your exit. And we're seeing some of those issues right now play out.
Yeah.
So.
I would like to add to what Raj said. So as a house, we have been very active on the capital market side for exits of our portfolio companies. While there have been some positive changes, for example, now investors have been put as controlling shareholders rather than being classified as promoters, and thereby they have reduced the overall holding period post-listing from 12 months to 6 months. There have been restrictions on the stake that is available for offer for sale, which again elongates the entire exit period. On the tax side, we have literally faced challenges where we have invested via domestic vehicle as well as an offshore vehicle. Domestic vehicle has had exit, but offshore vehicle had to wait for 6 months because they had to prove the tax residency certificate, the lower TDS certificate, and variety of other things. So yeah, these are some of the deterrents which elongate total exit timelines. So yeah.
Well, we can't sort of do this panel without talking about ESG and all of that. So Swati, the next one's for you. So, sort of what are the new areas of governance that Indian companies are making themselves subject to, such as, sort of ESG, alignment of management, promoter-less companies, quality of board. So 2 aspects there. What are these? Compare this to the touchstone of the ease of doing business in India. And, have we done enough, and how does this impact valuation? Because we've had other panels during this conclave about ESG and, the value addition stuff. So how does that all play out in the context of an exit?
So we have been working quite closely with our portfolio companies, and we have 25 portfolio companies across the 3 funds, right? Some are getting exited, some are under harvesting, and then we are in deployment phase from the 4th fund. There have been variety of initiatives that we have been taking across the board. If I talk particularly on the governance side, apart from the usual internal controls and change of auditors, etc., we have been making the board more independent. So we are inducting independent members. That's one. Second, there have been instances, especially because we try to invest again in first generation entrepreneurs, and a lot of these businesses are family-run businesses, right? So we are trying to limit the intervention of the family members and have more meritocratic setup, having more professional management joining the company. That's another thing. Then structuring of promoters' remuneration, right, which is in alignment with the investors, have more performance-related, exit-related is another intervention that we have been working on. Another thing is, in certain companies we have seen there are a lot of vehicles that promoters are running, and they are certainly not under the company wherein we are supposed to invest. So we are trying to restructure and see if there can be a whole core structure wherein the investment is coming and all of those vehicles can be put together. So that's on the governance side. On the ESG side, of late, we have, as a protocol, we have tried to inculcate that in the investment process. All our portfolio companies are required to do a quarterly compliance report, not just at the portfolio level, but at the fund level as well. So we consolidate, and then that is being shared with our investors. We have policies around POSH, around whistleblower, and related party transaction, waste disposal. We have been very active on the healthcare and pharma side, so waste disposal, etc., become an important part of it. Yeah, so these are some of the measures that we have been taking.
So I guess it would, Ranjit.
Yeah, just wanted to add that accelerating ESG programs within portfolio companies is very important for exitability. And I'll give you an example. This is a controlled transaction we had for schools where we co-created a student safety program, a child safety program with Veritas. And thanks to that, the first question one of the largest financial sponsors in the world asked us when they were considering buying the company, which they eventually bought, was, do you have a safety program, right? So I think it's very, very important that, whatever we list out for, say, a 5-year implementation of ESG within portfolio, if it's done within 3 years, that's going to accelerate your exitability.
Okay, so you've actually seen this being, sort of having an ESG program, having these things positively affecting exit value.
Yeah, it's real world stuff, this is real value.
I mean, there are a couple aspects to it, right? So one is, of course, the next sponsor who's going to buy the company is going to do ESG diligence as well, right? Similar to what we would do coming into that company. And so you want to show a track of improvement on that, on those scores. So it's important from that perspective. But in general, and there's enough data out there now that suggests that companies with higher ESG scores tend to create better value and more value for their investors. And similarly, if you think about it, less wastage, having proper governance, having a professional management team, some of those things in any case will be impacting the business outcome, right? So it is somewhat built into the numbers that you are seeing. You may not be able to extract them and see what the impact has truly been independently, but some of it is running through the numbers. And then, of course, numbers is part of the, what you get as an exit value, right? So your exit value is based on some, your profitability measures, metrics and stuff. So that all, it's sort of, ESG sort of plays out in that as well. So there's various aspects in which ESG is integrated into exits also now.
Okay, so back about, sorry.
If I may just add to that, I think the G of ESG, I think has always been there.
Yeah.
Whenever you invest, you want to do a diligence on the governance. The ENS, I guess, have come to more prominence of late, driven by investors. And now it's becoming part of the process. If you go back a few years, maybe 10 years, if you had an investor with a development orientation, there would be a checklist sent out, and then the thing was more to fill the checklist and send back rather than actually implementing the ENS part of it. But I think today we are seeing, even in our own investments, as a part of a pre-investment process, there is a whole ESG DD done. And actually getting implemented some of those findings with the companies involved. And so more and more we are seeing ESG conversations coming at a board level, where the boards are starting to take active interest in following up on ESG implementation and where we are and so on. I think this whole thing is coming into a lot more prominence today, all three, ES and G.
I mean, the Companies Act sort of drove this as well, right? I mean, back in 2013, you sort of had these provisions in the Companies Act that talked about the directors of a company having responsibility to all stakeholders. So it's almost like, sort of 7 years ago, you didn't have this conversation, but you were doing everything you needed to do. Now it's sort of more formalized into what you're seeing as, points that a company has to comply with, which directly affects exit value, positively or negatively, as the case may be. Would you agree with that, or? Yeah?
No, absolutely, and not just exits. Look, as private equity managers, you will see that even investors are asking for, a lot of ESG metrics. They want to see a proper process around it. They want to make sure that you as an organization are giving it the importance that it requires. Raj spoke about board level conversations. Many investors will require you to have those proper ESG monitoring happening at a senior level, at a partner level in your organization. So it's not just on the exit side, it's also, as LPs think about committing capital to you, this is an important aspect that they've started to evaluate.
Fair enough. So didn't mean this to be a panel on ESG. So, Srinath's going to save us with this one. So we were discussing the panel. Srinath was talking about some considerations or challenges when looking to exit by way of either private sales or public markets. So you had some thoughts on that in terms of exit and all of that. So please.
Yeah. So in our portfolio, there are 8 unlisted companies currently, 4 of which are in the IPO process. So we've been in that process of exit. One, we chose those companies which are exit oriented or likability in the market for various factors. But what we have seen is the market has changed quite dramatically, as everybody knows, right? So I think timing of the market, though very difficult, one must definitely do that, right? But I think precondition to doing an IPO is also, is the company ready for an IPO? So more and more everybody is looking at profitability all the way, right? So 3 years profitability track record, your various metrics which may be industry specific, be it gross margins or NPAs or EBITDAs or PATs, that definitely need to be in place for 2 to 3 years. As times are hard now, people look at those metrics very carefully. And in the 4 companies that are in the IPO process, one is getting launched. I believe it's subscribed well, so it will go through. One which is a stellar company, but demand for primary in that sector is weak, so we'll have to defer it. And one will launch in the next few months, and one by the end of this year. But the process of getting ready for an IPO takes 8 to 9 months, and it's quite a rigorous process in which the company goes through to get ready to an IPO. So I think in our orientation, we're always thinking, is the company ready? What it requires? What do we do for enabling the company to be IPO ready? Is the secretarial standards, especially for private companies which are coming off for a long promoter-run era, they need a lot of preparation on the secretarial standards to be met, and it takes some time to do that, right? And they're not even aware. So we need to start this process quite early in the process for an IPO to be successful. Of course, tailwind for industry is very important, right? Even now in this environment, a consumer company will probably get listed, but a lending company may get headwinds to get listed, right? Secondaries in lending business is doing well, but not primaries, right? So I think we need to be aware, and for timing, but performance of the company is very important for that to happen, really. And I think as an industry, and it was spoken in other panels, we should take some exit when we get it, right? There's no such thing as bad profit, so you must take exit when you get it, right? There is an inherent bias in the investing community that tomorrow will be better, why don't we just hold on? And tomorrow could be better, may not be better, or even you wait for tomorrow, your IRR falls very steeply every year that you wait. So I think you need to balance the inherent bias that the mind keeps telling you, let's postpone it, let's postpone it. But when you get an exit, if it's acceptable, you must take it and not. And that also cultivates, when you take it and force an exit, the team rallies around you and learns that as a skill for exits. I think that's an important thing we need to inculcate in our team, especially the young people who are in the industry. Exit focus, and there's no such thing as bad exit.
Yeah, I think someone once said, good company will sell, bad company won't sell. You've just got to manage it all. But, you know, instead of doing the last surprise question, putting everybody on the spot, I mean, just going around the panel, how would you know that your company is ready for exit? If you had to look at, you know, if you had a checklist and you had to tick off 2 points saying this company ready for exit or not, what would those 2 points be from your perspective?
So from my perspective, it's ready or not is most importantly how oriented the promoter of the company is towards an exit, right? At the end of the day, whether you do a private exit or an IPO, it's the promoter who should be very keen to facilitate that process, right? So at the time of investment, many people, at least now we've learned, the industry is matured. Before, when you wrote an exit waterfall, you wrote IPO will be done by such and such date or such and such year. When that time passed, people said, okay, we need to do an IPO and the conversation starts, right? Now I think we've all matured and we think from day one, you start saying, okay, what are your metrics? We need to get to the point of exit, etc. So the mindset of the promoter, I think in my wish list, that he should be mentally very ready to give an exit to the investor. He has to take that as a very serious obligation and get the company ready. The second wish list is to get the whole team in the company which makes an IPO happen also to be in place. Right? If you don't have a good CFO who's been there, done it, or is oriented towards it, you're going to have a very difficult situation for an IPO. The company secretarial standards generally are run by young, or let's say not so experienced on the IPO side. That needs to be very strong. So keeping the minutes properly and making sure all compliances are done, especially if you have a manufacturing, there are so many compliances to be done. And one fine day when you have to do an IPO, you find so many things are not in place. That becomes a challenge. So I think for me, the promoter and the company being ready is from the top of my wish list, and we do look at it very carefully before investing.
Swati?
I can take a stab at that. So there are, I think, 3 perspectives here on, you know, about how to time the exit. So I think the 3 fundamental driving forces, of course, one is commercial or economic, where you try to match the value maximization with the right timing with a buyer. The second is, I would say, the type of buyer, you know, the prep that you do with this type of buyer, because in a way, IPOs are a show horse, but, you know, the workhorse is strategic, right? So you basically want to push that. And the third is the GP's own motivations, you know, as Srinath was alluding to, that, you know, you have the chance for a great IRR, but sometimes GPs push for a multiple because, you know, carry is more multiple defined. So in all these 3 perspectives, you have to find a happy mean or a median in there and hopefully act.
Gaurav? Raj?
I mean, just to sort of top up to what Ranjit said, I would say if you get a buyer at your door, don't ignore. Yeah, I think
That's a nice aphorism.
we have sort of learned over the years. Sometimes you don't know how the future is, and a deal in hand is always better than waiting and watching and hoping for the best. Second is we do a number of control deals. And where you do control deals, the decision around whether you want to take it public or you want to sell to a strategic becomes a very key one. Because again, in an example where we have taken a company public, listed it, and it's currently trading at a premium, material premium. Your ability to fully exit is always a challenge because you get classified as a promoter, and then with it comes all kinds of challenges in terms of lock-in, even the lenders to the company are looking up to you and saying, we're not going to give you permission to exit. So all kinds of challenges. So I think those also become considerations depending on what kind of a buyer investor you are.
Fair enough.
Thank you.
So for us, it's very important to have clarity on where the exit is going to come from before we actually sign the document. And I say that, I'll give you an example. So, when you're looking at a deal, if it's a minority deal, then there are possibly two ways to go, right? You either take the company public or you sell to a larger sponsor. And if it's a control deal, then you could sell to a larger sponsor or you could sell to a strategic. So you need to have alignment in a minority construct for sure. You need to have alignment with the promoter on where that exit is going to come from, right? And it's good to have some sense of what is the size of the company at which they feel comfortable taking the company public, or passing on to another sponsor is an easier discussion to have because you're just getting replaced on the cap table. But taking a company public, there will be certain size and profitability metrics the promoter would like to meet. But my broader point is that those are the types of discussions you need to have upfront before signing on the dotted line. Also, the promoter needs to understand that he's taking private equity capital. There is an obligation to provide an exit. It will require some work from their end as well. The new sponsor that comes in may require diligence. They'll require management meetings and so on and so forth. So there needs to be alignment on that as well. So I think we look for clarity of where the exit's going to come from, as we're sort of thinking about getting into the deal, not in year 3 or year 5 or year 7.
Yeah, just to add to what everyone has mentioned, typically we try to hold an asset for 8 to 10 years, that we have a relatively longer time horizon. But this is one discussion that we tend to have with our founders every year, just so that they are aware that we are building up for an exit and we are not opening this discussion towards year 7, 8. Second thing is, we are very well aware about what is happening around the industry. Is the industry going for any sort of consolidation? There have been approaches that are being made. If that is the kind of factors, phenomena that we are seeing playing out, then we may, tend to work on exits relatively earlier than initially planned. Yeah.
Understand. Well, I think we're nearly out of time. So thank you everyone for your thoughts. I hope you guys, had as much fun as I did. But thank you everyone.
Thank you.
Thank you all for an excellent session on exits in the Indian landscape. Diversity. Please do it. And the birthday girl. Thank you.